what we get, but we make a life by what we give. And if it's true that the value of our life is determined not by the wealth that we accumulate, but rather by the way we distribute it, then realistically, all of us should be seeking to multiply our impact. And one way that we can do that is by planning our giving so as to maximize the tax benefits of it. And that's the theme that we'll be discussing tonight. Do good, get rewarded, how planning your given can multiply your impact. Just a little bit of information about myself. I started in tax back in 2008. I actually left tax for a time to be a full-time volunteer, came back to it 5 years ago, and earned my enrolled agent status in 2021. My firm is Capital Gains Advisory. We're an online tax and financial planning firm. We typically work with clients who can benefit either from year-round advice or maybe they have significant tax situations that they require a use of a professional for a year or two. And so those are typically the clients that we are working with. Uh, Before we go any further, we want to have our safe harbor statement. The information that is contained in this presentation, please don't rely upon it to make definitive decisions for tax or financial advice. You should always consult with your own accountant, financial advisor, and attorney before making these decisions. Also, if I am your accountant, financial advisor, please consult with me before you make these decisions. This is general information. Your specific situation may have certain nuances. And last but not least, this is what I call the "Don't Sue Me" slide. I'm going to also go with my stupid harbor statement, which is chances are at some point during this webinar, I'm going to say something stupid that maybe steps on a toe. If so, please forgive me. I don't try to overscript these presentations. I try to speak more from the heart, off the cuff. The downside of that is every once in a while, you have those little faux pas trying to speak extemporaneously. And if that happens, please reach out to me and please accept my apologies in advance. Okay, so let's talk about what we hope that you can take from today's seminar. First, we want to analyze the question to give or not to give. In other words, why should you or shouldn't you give at any given time? So we're going to look at good reasons to do so. We're going to look at bad reasons to do so. Then we're going to look at when a good deed gets punished. Yes, the good deeds that you do and give in to organizations, believe it or not, unfortunately, it can create problems. And those problems typically arise when individuals take improper deductions or they don't keep the records that are required of them. And so we're going to show you how to sidestep these potential traps. Last but not least, we're going to talk about some ways that you can make your giving more impactful. How can you save more on your taxes? We're going to discuss 3 different strategies that will help reduce your tax and allow you to do a little bit more. But before we get started, we want to go ahead and just give you a little bit of background information about charitable donations when it comes to tax law. Fun facts said no one ever. We're going to talk about tax. It's not always a fun subject, but it's an interesting subject. And one of the things that's most interesting when I talk tax with people, they're surprised how much tax really is law and not necessarily numbers. Typically, people think tax is accounting, accounting is numbers, but the reality is tax is law. And it's written into law in what's called U.S. Code 26, which is the Internal Revenue Code. Now, many people confuse Internal Revenue Code as being Internal Revenue Service. They're different things. The IRC, that's the actual tax code that's written by Congress. The Internal Revenue Service is actually overseen by Treasury, which is overseen by the president. They don't write the rules, but what they do is they interpret and they enforce them. However, your interpretation and their interpretation may not always meet in the middle. And when that happens, the court system gets involved to interpret the law. So while the IRS and Treasury do provide guidelines and regulations, what these are saying in effect is if you do this, and you get into an audit situation, we're going to yield to you because you've completed with what we're asking. However, if you don't and you disagree with their positions, this is where courts intervene. And typically, when courts intervene, typically, but not always, the IRS wins. They typically won't go to court unless they feel they have a really good case. Now, rules about charitable donations are all found in IRC Section 170, whereas rules governing the charitable organizations are covered in Section 501. And that may sound familiar. You may think 501, you may think 501c3. Well, literally, that's because it's Section 501, subsection C, paragraph 3 of the Internal Revenue Code, which is the basis for all things nonprofit and charity. Now, during this presentation, we're going to talk a lot about tax, and what we're specifically talking about is federal taxation. State rules different from federal taxation. And we have on the screen a couple of states where they actually offer benefits that are not available at the federal level. So if you live in one of these states, Arizona, Colorado, Minnesota, Iowa, Kentucky, Maryland, Mississippi, Montana, Missouri, or North Dakota, there are specific programs, endowments, or credits that are available to those residents that you need to make sure that you or your tax professional is aware of. So, now that we've kind of got this background information out of the way, it's a little bit of a segue for our first learning objective. We're going to talk about the subject of to give or not to give. Now, in the beginning, we cited Churchill's words. Obviously, giving is important. It's a good thing, but the reality is for individuals who have limited resources, it is important that you understand the pros and cons about donations, at least from a financial point of view. And this way that you can make informed decisions that don't necessarily hurt your family. Now, for federal tax purposes, charitable contributions are generally itemized deductions. Now, if you're not familiar with tax, the question that may come to mind, what is an itemized deduction? Well, essentially, itemized deductions are the sum of certain qualifying personal living expenses that are allowed as deductions by tax law. Specifically, the four most common ones are health expenses that exceed a certain threshold, mortgage interest, state and local taxes, and your charitable donations. However, not everyone itemizes. In fact, 90% of Americans take what's called a standard deduction. As a taxpayer, you can choose from one or the other. The standard deduction is simply a fixed amount that increases annually along with the rate of inflation. Now, if you take the standard deduction, in reality, you are not benefiting from any charitable contributions, at least from a tax purpose, unless you are a business owner, in which case there is a special caveat. The Treasury Regulation 16215 allows donations in exchange for things like naming rights or other marketing opportunities to be considered a deductible business expense. So, for instance, if I were to sponsor a charitable organization for a fundraiser and they put my name everywhere on the advertising and on the programs, I could consider that an advertising expense because I legitimately expect to receive some sort of business benefit. So that's the only situation when a taxpayer who takes the standard deduction up until now would get any sort of tax benefit. However, regardless of whether you're a business or whether you're an itemizer, if you take a deduction, it's not a dollar for dollar benefit. And this is a concept that often is misunderstood by many individuals. They think, oh, I'm going to write it off. Well, a write-off is good, but the reality is it's not a credit. A credit is a dollar for dollar reduction of your tax. A write-off or a deduction is really for the dollar that you spend, take it, multiply by your tax rate, and that's your benefit. The average American has an effective tax rate of 14.5% or a marginal tax rate of 22%. So realistically, the average American is getting somewhere between 15 and 22 cents of a benefit on their tax for their charitable contribution. It's not quite as high as many may think. And so this is why we ask the question to give or not to give. If you are of limited resources, it is one thing that you need to understand. For cash and cash-like donations, tax should never be your only consideration because out of pocket, you will always have less, even if you're giving. Doesn't mean you don't get a tax benefit, but the tax benefit doesn't offset the donation in its entirety. It's just simply an extra incentive to encourage you to pursue the opportunity to do something philanthropic for your community. So we're not trying to dissuade anyone. We're just trying to set a realistic expectation. And so, with that in mind, there's also another factor, not just of the if you should do, but even if you decide, I want to help, I know I'm not getting a full dollar for dollar benefit, that's okay. I really want to do something good for my community. Well, another thing you have to ask yourself is when should you do it? And specifically, this year is a great year to talk about this subject because this year we have some changes to the tax rules that are taking place over the next 2 years. And this is as a result of what's called the One Big Beautiful Bill Act, or as we like to call it, OB3, to make it a little bit simpler. So, OB3 has some new rules. So, for instance, in the last slide, we talked about those who are taking the standard deduction. And standard deduction, they don't really get the benefit. Well, that's going to change starting January 1st, 2026. Now, that's about 45 days from now. So, starting January 1st, 2026, for the 2026 tax year, those who take the standard deduction will be able to claim up to $1,000 per filer in a deduction for their donations to charitable organizations. So, for instance, take my situation. My wife and I, we regularly give to charity, but we are standard deduction people. We don't own a house, so we don't itemize. As such, we don't really get a tax benefit from our donations. So rather than trying to donate as much as possible in 2025, strategically for us, it's probably going to make more sense to make sure we're donating at least that $1,000 each in 2026, at least. And that way we get the full benefit of that deduction, even if it means some of what we would donate in 2025 shifts into 2026. However, for other individuals, the reverse is going to be true because in 2025, something called the SALT cap or the state and local tax cap goes from $10,000 to $40,000. One of the reasons that 90% of Americans are taking the standard deduction is in 2017, something called a SALT cap was passed as part of the Tax Cut and Jobs Act. That was President Trump's first term big tax bill. And what that did, it reduced the amount of state and local taxes that an individual could itemize to no more than 10,000. Now, while that number seems to be a large number, you have to remember in certain places like California and New York, salaries are very high. And so it's very common for individuals to make over six figures. So if you're paying 6, 7% in there, you're paying 6,000, 7,000, 8,000 in state and local income taxes. And when I say local income taxes, if you're in New York, New York City has an additional tax on top of that. Then you add to that property taxes in those states where the properties have enormously high values. Most of those individuals weren't getting the full deduction for their state and local taxes. That's going to change starting 2025. So, what that means is more and more individuals who own homes will be going back to taking itemized deductions. That SALT cap will go up to $40,000 for most individuals. So if an individual is going to be itemizing, well, then it may make more sense for them to go ahead and start thinking about their charitable deductions now. That way they get the full benefit. Also, in 2026, individuals who are in the highest tax bracket, which is a 37% tax bracket, they're actually going to have reduced deductibility of charitable contributions. So they'll be capped at a 35% benefit. So they're going to be squeezed on the top end. And there's also going to be something called a 0.5% AGI floor, which is small. But either way, that's a 2.5% different for those individuals on the benefit. So rather than waiting to 2026 to do all their contributions, they might want to pull some of that into 2025. So when thinking about charitable contributions, one of the questions that you do have to ask yourself is, when is it ideal for me to go ahead and make these charitable contributions? Should I do it now at year end or should I wait till 2026? A lot of that will depend on your own individual tax situation. Now, you decided that you want to give, you decided when you want to give, but you now have to think about whom you're going to give, how you're going to give, and what steps you need to take to make sure you document it properly. Unfortunately, while charitable donations are a great thing, the reality is they are easily abused. And so what has happened is tax law has created a series of guardrails, as shown in this illustration, which can make something that should be quite easy to do quite difficult or quite confusing. And so what we're going to do is we're going to take this little diagram, which is kind of the complex web of tax treatments for your donations, and we're going to break it down into its most basic considerations. And so what we really want to focus is who you're giving to and what it is or how it is that you're giving the donation. Because depending on these two factors, there's going to be things that you need to know in order to maximize your impact. So let's focus on the first part. And this is probably the easier of the two parts. The who am I giving it to? So we're going to use the term tier one and tier two. Now, I use this term. This is a me invented term just for the ease of explaining this. This is not an official term. It's just simply, and it's not trying to say, hey, if you're operating a private, non-operating foundation, that you're inferior to a tier one organization. That's not the purpose. It's just simply to make it easy to understand. So tier one is the IRS preferred, or I should say the revenue code's preferred organizations. These are 501c3s. These are churches. Universities are good examples of 501c3s. And they can include what they call private operating foundations. Then there's a lower tier, a tier two, private non-operating foundation, lodges, and some other 501c organizations, so long as they are raising the money for an approved non-for-profit charitable cause. Well, why does this difference exist and what does it mean? Well, when Congress was writing the tax code, they made the assumption that because 501c3s are generally public charities, and as such, they're subject to public scrutiny and they depend on public funds, that these organizations would be less likely to abuse such situations because they knew that trust with the public was very important. On the other hand, private foundations don't necessarily have such public scrutiny. And as such, Congress believed that they would provide greater opportunity for abusive transactions, for inurement or self-dealing transactions, the enrichment of those running the foundation. So what they did is they placed more significant limits on the amount of donations that an individual can deduct for these private non-operating foundations. So that's something you need to consider. If you're given to an organization, is it a 501c3? Is it a 501c3 private non-operating foundation? Is it another type of 501c organization? In the case of churches, churches don't have to register as 501c3s, but they get the same treatment, even though they don't necessarily have to register. So you need to make sure that the organization that you're giving to is one of these two types of organizations. Otherwise, even if the cause is a good one, the donation is not in and of itself deductible. So that's the first thing. Who am I giving it to? And that's pretty easy. The IRS actually puts out a tool, a tax exempt organization search, TEOS. So if you go to irs.gov and you type in TEOS, that tool, you can search the organization. Unless it's a church or a government organization, it should be there. If it's not, chances are it's not going to be a deductible contribution. However, for most people, this point isn't a hard one to understand. And this is an easy one to comply. You just find a qualifying organization. Typically, when an individual gets in trouble with their donations, it's due to this next step. I talked about who you can give to, but now we're going to talk about what you can give. And you can give a lot of different things, but depending on what you give, you have requirements that you must meet in order to claim the deduction. And this is what we call substantiation requirements. In other words, you have to prove that you donated it to who you said you donated to. And this is something that is non-negotiable. This isn't just an IRS position. This has been written by Congress into the tax code. And so anytime a taxpayer takes these fights to court, almost always they lose due to a lack of records. So what are the records that are required of you? Well, and this is where it gets a little complex. So let's talk about cash. And we talk about cash, we really mean cash, check, or credit card. All donations must have bank statement or a receipt showing the name of the organization to support it. So if you're actually giving cash, let's say you're putting cash in the collection plate, you have to have a receipt that you put that cash there. Otherwise, you can't actually claim the donation. If the IRS catches you, they will disallow it. If the amount of cash is over 250 or the check or the credit card, then tax law requires you to receive a contemporaneous written acknowledgement from the organization. Now, the word contemporaneous can seem a little bit scary because it may seem like you need to have that written acknowledgement right then and there. However, you're allowed till April 15th of the upcoming year, so before you file your tax return, to get that written acknowledgement. And so that's why most church organizations, most charitable organizations, they will give you a letter at the end of the year stating how much they have you on record as donating. It's to comply with this requirement. However, the reality is you have to meet both requirements. So, thinking about cash, realistically, rather than using actual cold hard cash, check or credit card is so much superior because you always have this bank statement or receipt that you can refer back to. Whereas if you're actually donating cash, you need to get some sort of paper receipt in addition to this contemporaneous acknowledgement from the organization before April 15th. Now, everything else falls into the same bucket. Now, we didn't really kind of draw this well. We have appreciated long-term capital gains property and any other sort of property. Now, these also have their own substantiation requirements. In the case of any sort of capital gains property, you need to be able to prove your basis, what you paid for it. If it's real property or land, then also things that you may have deducted in the form of depreciation come into the picture. All this is called your adjusted cost basis. However, if the value of it is over 500 or 5,000, there may be additional substantiation requirements. Clothes or household items may require an independent appraisal if their aggregate value of all of those that you contribute during the year is over $500. Now, let's let that one sink in a little bit because a lot of us, we take our clothes to Goodwill and typically they give us a little receipt. However, if we claim that the value of those clothes during the year is over $500, we actually have to have an appraisal, a qualified appraisal. Well, and the Goodwill can't qualify, they're not qualified to appraise it for you there on the spot. So that's something just to think about. Do you really want to go through all that hassle to try and do that? Now, there may be some certain situations, we'll talk a little bit about that later. If it's not clothes or household items, the threshold for an appraisal is $5,000. And I think if it's over $20,000, then you actually have to send the appraisal in along with your tax return. So these appraisals, this is not something that's negotiable. It is something that is a requirement written into the U.S. tax code in section 170. Under audit, if you don't have the appraisal, you will lose every time. With clothes, technically, the law says clothes not in good used condition over $500. However, this is another issue which gets a lot of people into trouble, and there's actually tax cases. We'll talk about one of those here in the next slide. Most taxpayers, they think, well, the government has to prove that it wasn't in this condition, and that's a wrong assumption. So we think that because we see crime dramas on TV and we see how the courtroom works, and we know that innocent until proven guilty. However, the reality is, for tax purposes, it's not criminal case, it's civil. And as such, because the law is written in such a way that you are required to provide proof of any deduction or any exclusion, the burden of proof is on the taxpayer unless you shift it by providing all the documentation that has been requested of you. So you have the burden to prove that it was in good condition, or that it was, that it was valued over $500. It's not the government's responsibility. It's your responsibility. So we put this photo of a Hermes thing. Obviously, Hermes bags are really valuable, but it's something to think about, right? Let's say you have an old bag and you want to donate it to a charitable organization. Well, you need to make sure you get a qualified appraisal no more than 60 days before the donation date. Otherwise, this beautiful bag, this beautiful donation, this wonderful thing, if the IRS were to randomly select you for audit, you could actually lose the value of the donation. Obviously, it's not the most important thing, but it is important because you're giving this and you should get something back. And it would be a shame to lose your deduction just because you didn't follow a small administrative step. Now, here's a case in point. Besaw versus Commissioner. This was a case from 2025, so it was this year. I think it was July. So Besaw claims $6,000 plus in non-cash charitable donations. So these were donations of clothes, of property. Well, if you go back a couple slides, anything $500 for clothes, anything over 5,000 requires the qualified appraisal. The court admitted they believe that he made the donations. He had names, he had dates, he had signed receipts, he had letters, but because he didn't have the appraisals, he didn't meet the substantiation requirements, and the court had to throw out his deduction. And when they throw out the deduction, if it's a large enough amount, then other issues can come in because then you can get penalties and fines and interest and all of those things. And that's when your good deed really unfortunately can get punished. And that's what we want individuals to be able to enjoy. So there's some other common points that tend to get people in trouble when they're having these kind of audit considerations. And to be fair, BSA was a pretty low value case. Most of the cases that you'll see these issue comes up with are multi-thousand dollars, 20, 30, 40, 80, $100,000 or more. But typically the situation, a lot of it either rolls around cold hard cash or these property donations. Some of the common points of contention, the appraiser needs to be qualified. It can't just be a disinterested party. It can't be someone who works for the charity. It has to be a qualified appraiser. It must be timely, it must be within that 60-day period, must be in writing, and it must be believable. The value that they assess has to be believable. I mention that because you may see ads on Instagram if you show any sort of interest in tax or Facebook that say, hey, we can get you this qualified appraisal for art or for land, and they sell this thing, and it's actually a common scheme that the IRS calls part of their dirty dozen. These conservation easements or these art investments where they inflate the value for the charitable donation purposes. The appraisal must be believable. That gets thrown out at tax court. And lastly, this is another one. The donation must be permanent in nature, and there must not be quid pro quo. In other words, you can't give something with the expectation of getting something in return. That's another situation that often gets charitable contributions thrown out because there was some benefit received in exchange for the charitable donation. So just keep those things in mind. We don't want you to lose your donation because you miss a step in the administrative process. The best thing is if you're dealing with large values, work with the professional just to make sure, or read the IRS publication until you're absolutely sure that you understand it. So, if that wasn't complex enough, we're going to add a third layer of complexity on these tax treatments. And I promise you, this is the last layer of complexity. This is probably a little bit the most technical, so I do apologize. I know it's 8:30, so hopefully I'm not putting anyone to sleep here. But if there is anything that's going to do it, and this is pretty good. This is like white noise. Um, we talked about who you give to, what we give. But there's also limits placed on the amount of a tax deduction that we can recognize in any one year. And these limits are based on our adjusted gross income, which is our gross income. That's our income before deductions, with certain adjustments. And so the limits depend on one, what organization you're given to, and what type of property that you're given. So if you're given to one of those tier one, the 501c3s, the churches, and you're given cash, check, credit card, you can deduct up to 60% of your adjusted gross income in any given year. Anything else will carry over to a future year. Now, if you're donating property, generally it's going to be up to 50% of your adjusted gross income that you can deduct. But if it's appreciated long-term capital gains property, and we'll talk about what that is and why it's so low, you can only deduct up to 30% of your adjusted gross income. Now, if it's a private foundations, cash or property is 30% of AGI, long-term capital gains property up to 20% of AGI. If it wasn't complicated enough, these limits aren't separate. they actually have interplay with one another. And we're going to use this next slide to kind of explain how that works. So imagine the situation. Imagine I earn $100,000 a year. I wish, but imagine I do. And I have $10,000 in itemized deductions before my charitable contributions. So if I make $65,000 in cash contributions, remember cash is limited to 60% if it's to a 501c3 or a church. So if I contribute 65,000 to my congregation, my AGI is 100,000. My limit is 60% of that, so my limit is 60,000. So that means I get the 60,000 in deductions and I carry over 5,000 to the next year. But let's say I want to mix and I want to do some cash and some property. Same situation, 100,000, 10,000 itemized deductions. I don't really know why that's there. It doesn't really matter, but cash contribution, I donate 30,000. That's within my 60% limit, so I'm okay there. Property, 50,000. Even though I'm at that 50% limit, I have to reduce that limit, that 50,000 by the cash contribution that I've already contributed. So that will limit what I can take. I can only take 20,000 in property and I'll carry 30,000 over to the next year. And so cash and property and stock, 100,000 AGI. Let's say I'm doing 10,000 in cash. That's within the 60% limits. 10,000 in property. That's within the 50% limits. If I do 15,000 in appreciated stock, well, remember I got a 30% limit on appreciated stock. So that's 30,000, 30% of 100,000. So less 10K cash, less 10K in property. That leaves me in a situation where I've exceeded that by 5,000. So that carries over to the future. Tier two limits, kind of the same principle, but you actually have to consider the contributions that you made to these tier one organizations. So summing all that up, if all you're donating is cash, hey, that's very easy. If you're donating cash and property, if it's a significant amount that you're donating, you may need to run it over with someone just to make sure you don't get in a situation where you go above your limits. Now, it's not the end of the world if you go above those limits. It just carries over to the next year. But the reality is that's an opportunity cost because you don't get the tax benefit now. You have to wait a year plus for you to be able to recognize the benefit, and that may be meaningful to you. So just keep that in mind, especially if what you're looking to donate is what they consider long-term capital gains property, or if you're donating to one of these tier two private foundation organizations. Now, this is the part most of you probably signed up for. All the boring stuff is out the way. This is what everyone wants to know. How can I save money on my taxes? Well, we're going to talk about 3 specific strategies that can allow you to do that. And they are bunching, avoiding capital gains by donating appreciated stock, and avoiding RMDs by doing something called the QCD. Now, we are going to go into those in the next slide, but those are the 3 strategies: bunching, avoiding capital gains, avoiding RMDs. So let's talk about bunching. Now, bunching is probably the least important of these strategies with the change in SALT cap, but we wanted to include it because we see it all the time. As we mentioned, contributions are part of your itemized deductions. Some people are always on that threshold of they're almost itemizing, but they're not quite. And if that's the case, this is where bunching is a good strategy to pursue. What a lot of folks do is they'll spread their donations out each year. I'll donate, 500 in December in year 1, 500 year 2, 500 year 3, or 2,000, 2,000, and 2,000. And what they don't realize is if you're one of those people who's on the border of itemizing, that doesn't really make sense to do it that way. What would make sense, instead of doing, let's say 2,000, 2,000, 2,000, do 6,000 in one year and the other 2 don't give. The reason that works that way is because if you're one of those people who's on the threshold, you want to make sure that your itemized deductions are as much as possible. Otherwise, you're better off just taking the standard deduction. So we use a situation here, assuming the person has 20,000 itemized deductions each year and they donate 2,000 to charity each year. This will leave them with 22,000 in itemized deduction. We kind of made up some numbers for the standard deduction. But what ends up happening is they itemize every year and they get a $66,000 in tax deductions across 3 years. But if they were to pursue what they call the bunching strategy, make all those charitable donations in year 1, What ends up happening is they take the itemized deduction year one, the rest of the years they take standard, and they end up with more deductions over a 3 year period. Again, this strategy doesn't work for everyone. It's not the sexiest of strategies by any means, but it is a practical one and it is a simple one to implement. A lot of times it's just a matter of knowing the difference between your itemized deductions and your standard deductions. If you work with a professional, you can always ask them to print out your Schedule A, print out your itemized deductions so that you can see the difference year in and year out. And that way you can know how far off I'm in from itemizing. If it's not much, then that may mean you may have a good opportunity to apply a bunching strategy and generate some tax savings. This one's not going to generate you huge savings, but it is an interesting one. Realistically, for people with the standard deduction, there's a bunching strategy this year because of the tax law change. For people who may be dealing with the phase out in 2026, they may have a bunching opportunity in 2025 to shift things forward. That's kind of the concept here. But again, this one's probably not as powerful as it was a year ago. However, now we're going to talk about the one that really is powerful. And it's powerful this year because stocks have ran up so much. You may remember this nightmarish diagram, and we talked about appreciated or long-term capital gains property. It has such a low limit, only at 30%, whereas cash allows you to deduct 60%. And maybe the question you may be wondering is why does it allow so little? Well, that's because it can save you so much in taxes. This is really powerful one because this is one where you actually get a double benefit, and that is rare in tax. Tax rarely allows you to double dip, but gifting appreciated capital gains property is one opportunity where you can double dip. Now, in order to do it, one, the organization has to be able to accept the property. So typically with small organizations, that may present a challenge. Two, it has to be long-term appreciated property. So that means you have to have had it for at least a year and a day, not 1 year, at least a year and a day. If it's not stock or, well, if it's cash, it's not going to have appreciated. But if it's not stock, then if it's property, like real property or land, you have to have an appraisal if it is above the limits that require an appraisal. So just be careful with that. But we'll focus on stock because this is probably the easiest way to implement this strategy, especially if you have things like employee stock that you've earned that has big old huge gains and you don't really want to sell it because if you sell it, you're going to be taxed on the gains. Well, and here's the way this works. So let's say, for instance, I want to gift stock and I just decide, I'm going to sell the stock. I have a $10,000 gain in the stock. I'm going to pay the 15% capital gains tax. That's 1,500, and I'll donate the rest, which is 8,500. Well, my tax savings on that, on the donation, if I'm in the 24% bracket, we'll just use an assumption, it's going to be somewhere around $2,000. So net, I do save something on my taxes, but it's only about $500. However, if I sell the capital gains property, or sorry, if I donate it, one, I avoid the sale, which means I avoid capital gains. However, tax law allows me to write off the full value of the donation. It doesn't care about what I paid, and that's not always the case, but in this situation it is. It allows me to write off the value of what I'm giving up. So not only do I avoid the tax on the sale, but now I actually can give a little bit more. And so my tax savings, $2,400. So you see net, the difference is pretty substantial. 2,400 versus 500. On something that's $10,000, that's a nearly 19% save. Now, if you're in an even higher tax bracket, those amounts go up because you've got to deal with higher capital gains and you have to deal with something called net investment income tax. So gifting appreciated stock is one of the best and easiest ways to really double your impact. You get the double dip, and tax law doesn't let you do that so often. So if you have a situation this year, obviously the market's up about 18%, maybe it's about 16% with some of the recent pullbacks. If you have stock and you're sitting on these big gains, you don't really want to sell, but you want to do some charitable work, well, that might be an opportunity. Gift a couple shares. You save yourself from the capital gains tax on the sale, and you get some of the tax savings on the fair market value of what you're donating. Let's talk about another one, and this is qualified charitable distributions. It's not as powerful. However, it's another powerful strategy, but this one really is more for the retirees. So, unlike other donations, and this is one advantage of QCD, QCD does not require you to itemize. So, if you take the standard deduction and you have a traditional IRA with an RMD, you can apply this strategy. So, any traditional, this is non-inherited accounts, traditional IRAs that require you to take a minimum distribution, rather than taking the distribution, you can elect to do what's called a qualified charitable distribution or a QCD. Now, what happens is when you take the QCD, you have to do it before you take your RMD. If you take your RMD out, don't do the QCD, otherwise you won't get the benefit. You can elect, if you do the QCD before you do any RMDs, you can elect that the QCD takes the place of your RMD. So you don't need to take your required minimum distribution, or you can take less of it if you don't do the full amount of the QCD, of the distribution of your RMD as a QCD. I know it's a lot of alphabet soup there, and I do apologize. Let's use a math example that can kind of help us visualize this. So let's say I'm a retiree. I have to take a required minimum distribution for my IRA of $10,000. What I'm going to do is I'm going to go ahead and pay the tax, and then I'm going to donate the value of the distribution. So I pay the tax. The value of the donation is 7,600 after the 2,400 in tax. My tax savings on that, 1,824. I actually pay $576 in tax. If I do the QCD, I don't have to take the minimum distribution. So I pay no tax on the distribution. Even though I make the $10,000 donation, I am not allowed to count it as a donation. So that you don't get the double dip here. However, you don't actually end up paying any tax on any RMDs because you never took it. So on the net, you still end up saving a little bit on doing this QCD as opposed to doing an RMD and donate. And added bonus, you're able to give your charity a little bit more. Now, you don't have to give them the full 10,000. You could give them 7,600. You could pocket the 2,400 for yourself, and you're perfectly fine. That's your personal decision. There are limits on the amounts that you can do in QCD. I don't know those limits off the top of my head. They're pretty substantial. In fact, there are actually some unique strategies that you can do one time with the QCD. You can fund what's called a charitable remainder unit trust or a charitable remainder annuity trust or a charitable gift annuity. So these are some interesting things you can do. They're very high level, very exotic. We're not going to discuss them here. But the qualified charitable distributions, if you're a retiree and you have to deal with required minimum distributions, this is an easy way for you to go ahead and avoid that tax, and do good for a charity that you really feel strongly about. So, just reviewing our three strategies, we talked about bunching. If you itemize, consider bunching if you're really close to the threshold. That way, you make sure you get all the donation, all the value of the donation, or as much as possible. If you have appreciated long-term capital gains property, you can consider gifting it to a 501c3 or church to avoid the tax on sales and also recognize the value of the donation. And then you can do the qualified charitable distribution. If you have an IRA required to take RMDs, you can avoid them or reduce them via this qualified charitable distribution. And that is the end of our presentation. If you have any questions, feel free to go ahead and throw those in the chat. We are happy to provide some general answers. Uh, I may not answer all questions entirely because, contrary to what my wife likes to think, I don't know everything. Um, I do have limits, so if we can't answer it here, we can certainly send it to you via email. Conversely, if you'd rather just email us or call us, our information is on the screen. Feel free to write that down. We'll also be reaching out to you just to get some feedback as to how was your experience, what we could have done better, what we maybe should just drop for the next session. Thank you so much for your time today, and we certainly appreciate you attending this webinar with us.